Let's learn insurance together. Purpose of Life and Health Insurance, Chapter 1, Nature of Insurance and Concepts of Risks. Insurance is a type of risk management used to protect a person or a company in the event of an unexpected financial loss. The insurer is the insurance company. The policy owner or policyholder is the person or business that purchased the insurance. Premium is the monthly payment. The monthly payment is required to keep the policy in force. Claim is a demand of payment for a loss, the claim that you make to the insurance company after a loss. Domestic insurer, an insurance company within the states in which it was incorporated and in which its home office is located. So an insurance company incorporated in Florida and doing business in Florida. Foreign insurer, an insurance company operating in a state other than where it was incorporated and in which its home office is not located. So a company incorporated in Florida but doing business in New York. Alien insurer, an insurance company incorporated outside of the United States, conducting business inside the United States, is referred to as alien. Risk is the uncertainty regarding loss. Speculative risk is not insurable. It's a type of risk that involves the chance of both loss and gain, therefore not insurable. Health and life insurers do not consider speculative risk to be insurable because of its potential for gain. Example, playing blackjack at a casino, there's the possibility of gain or loss. So the insurers only insure loss, which is pure risk. Pure risk is insurable, the type of risk that involves the chance of loss. There is no opportunity for gain, therefore it's insurable. Risk pooling. It's a basic principle of insurance where a large number contributes to cover the losses of a few, also known as loss sharing. The law of large numbers is a basic principle of insurance that says that the larger the number of individual risks combined into one group, the more certainty there is in predicting the degree or amount of loss that will be incurred in any given period. So the larger the group of people, the easier it becomes for them to predict the amount of loss that an insurance company will have. Hazards and perils. Hazards are any factors that give rise to a peril. Peril is the immediate and specific event causing loss and giving rise to a risk or loss. In an example of a house being destroyed by fire, fire is the peril. A hazard leads to a peril, which leads to a loss. Types of hazards. Physical hazards are the individual characteristics that increase the chance of a peril. Physical hazards may exist because of a person's physical condition. Blindness and deafness are physical hazards. Moral hazards are tendencies that people have that increase the chance of loss. Drug addiction is considered a moral hazard. Moral hazards are also individual tendencies, but they arise from an attitude or state of mind causing indifference to loss. For example, a person may have a habit of driving recklessly, with no fear of death or injury. This influence is a moral hazard, increasing the chance of death and injury. Methods of handling risk: avoidance, reduction, retention, transference. Risk avoidance. Simply avoiding as much risks as you possibly can. Examples are not opening your own business for fear of failure, or never flying because of the risk of being in a plane crash. Avoidance is effective but not always practical. Only a few risks can be handled in this manner. Risk reduction. It's another means of attempting to lessen the possibility of loss by taking action to reduce a risk, like installing a fire alarm in your house to lower the possibility of fire. This may only reduce the risk of loss from fire. Risk retention is expecting the risk and confronting it when it occurs. One way to handle or retain risk is self-insurance, but not everyone has the money to do that. Risk transference is the most effective way to handle risk by transferring the loss to another party. Individuals and businesses get support in case of a loss. Although purchasing insurance will not eliminate the risk of death and illness, it helps individuals or groups with the losses these risks bring. Elements of insurable risk. The loss must be due to chance. In order to be insurable, a risk must involve the chance of loss and outside of insured's control. The loss must be definite and measurable. An insurable risk must involve a loss that is definite as to cost, time, place, and amount. An insurance must be able to determine how much the benefit will be and when it becomes payable. The loss must be predictable. This enables insurance to estimate between death, illnesses, disability frequency, and severity of future losses, to set appropriate premiums. All this can be projected by statistics. The loss cannot be catastrophic. Therefore, an insurance company cannot issue a policy for trillions of dollars to a single life because that would create a catastrophic loss to the company. The loss exposures to be insured must be large. An insurance company must be able to predict the losses based on the law of large numbers. As a result, there must be a very large group of people to be insured, to be able to group them into classes with similar risks. People are grouped according to age, health, sex, occupation, and other classifications. The loss exposure to be insured must be randomly selected. Insurers must have a fair portion of good risks and poor risks in order to have a financially good company. A large portion of poor risks would financially threaten the company because there would be too much loss. There is also a tendency called adverse selection for less favorable insurance risks. People in poor health continue insurance to be a greater extent than other risks. This is the book where I took my notes from. I hope you enjoyed it. Have a good day.